Hello and welcome back to our YouTube channel. My name is Neil Kane. Today I'm going to be talking to you about some of the broader elements of the economy, some of the signals that we see that the economy could be slowing down. However, that really hasn't translated to lower stock market performance. As we've seen, the US market has been pretty much on fire over the last couple years. But we're going to be diving into, could that trend be bucked by some of the other slowing areas of the US economy? So when we talk about the signals, one of the signals that we really use at Capital Financial Planners is what's called the Conference Board Leading Economic Indicator Index. This is an indicator index that is put together by economists that use 10 forward-looking indicators such as building permits, new orders, unemployment claims, stock prices, consumer expectations, as well as housing starts to try to determine what is the economy going to do next. And in recent trends, quarter over quarter, we've seen that fall. Now, this isn't a recession guarantee by any means, but it's a clear signal that growth is slowing domestically. So if we look at the chart of these US economic indicators, why have we used this as a signal? Well, because it's very clear that this conference board has had pretty good luck in predicting US recessions. If we look at the 2008 recession, the conference board leading indicators was going negative even when GDP was still positive. The same could be said in the 2000s. The same could be said in the 1990 recession, and then dating back to 1980s as well. The confusing element that we have going on currently is that we have been negative since about 2022, and we had actually been improving but have now started to slip down again. So it's a very unusual reading that we have, but yet we're here. We have it, right? So currently GDP has been positive, uh, but leading economic indicators are starting to slow down again. So it's something that we're going to watch and see how things develop. So if we look at each of these elements, consumer confidence is down. In fact, we've had some of the lowest consumer confidence readings that we've had in a decade. We have fewer businesses purchasing goods. We've got reduced construction and housing permits, and we have rising unemployment claims. So let's look at unemployment a little closer here. We've put together a chart going back to 1950, and we can see how every time we've had a spike above the zero reading here, it's generally led to a recession. In fact, during the Great Financial Crisis, we spiked in unemployment. In 2001, we spiked in unemployment, and the recessions are depicted here by the gray bars. So we've highlighted the current reading, which is unemployment here in 2025. We see the spike above the 0%, and we can say that we are in kind of the red zone here of what would have been a recession in the past. However, this time could be different. There's a lot of cash sitting on the sidelines that is waiting to buy any market dips, is waiting to reinvest. So it's very hard to say. But what we can say to all federal employees that are nearing or in retirement is that now's not a time to be over your skis in terms of a skiing analogy. You should not be in a riskier allocation than you should be. So the question is, what does that mean? Well, we define allocation strategy as a bucket strategy. This is a much more intentional way of allocating your TSP or retirement account if it's outside of a TSP now, by actually looking at what your cash flow strategy is over the next 7 years and determining how much should be at risk, in safety, etc. So let's look at that a little closer. Okay. If we are talking about structuring your TSP buckets, anything that's outside of 7 years in terms of money that will be spent, those assets should probably be left in something that has growth potential, such as your TSP C fund, S fund, or I fund. You can accept this volatility because at the end of the day, you're not going to be utilizing this money for 7+ years. Now, anything that's kind of in the middle of that, we call the transition bucket. This could be funds like the F fund, maybe the L income, or the L 2030 fund, something that's going to have more of a moderate feel to it, not going to be fully impacted by a market downswing, but something that's not super low risk either. Now, any money that's going to be utilized in 3 years, this is what we want to be in a safe bucket. This is defined in TSP terms as your G fund. We define it in the outside realm in terms of retirement accounts as treasury, index funds, other low risk funds that generate interest, but generally have very low volatility and preserve capital. So that is conceptually how we design allocations. We don't do them by just an age-based format. We really do them by how much money you're going to be spending over the course of these next 7 years, how much can go into growth, how much needs to be into safety. Now, when this comes to you all and you're still a TSP investor, you're still kind of putting money into your TSP, we want you to check these allocations and make sure that you've got something that's you're comfortable with in terms of volatility. Make sure you're rebalancing. If you've had a huge surge in your equity side of your portfolio, make sure you rebalance that down to what your mix should be. Adjust those future contributions. Maybe not all of them need to be going into growth. Some could go into transition. Some could go into safety if you're getting closer to retirement or in retirement. Of course, you won't be contributing. And then avoid any emotional adjustments. If the market sags, do not panic. Don't cut out at the wrong time. It's time for preparation, not panic. That's why you want to think about these things when the market's at a really nice high level like it is today, and start making the preparation if things go wrong. Remember that leading economic indicator, it's not a guarantee. We've been in a low reading for about 3 years now, right? So if you would have panicked at the beginning of that, you would have missed some great years in the market. That's why we want to go back to that bucket strategy. And remember, as federal employees, your risk profile is a bit different than other private sector folks. You've got a pension that's going to also kind of feel and look like what someone's conservative investments would be. You're not going to have to utilize as much as your retirement savings as, let's say, a private sector person with only a 401k. Okay. And again, we go back to that overreaction. You adjust, you prepare, you align, but you don't panic. Okay. So when we talk about the federal retirement strategy and we talk about slowing economic momentum, your TSP really should be about resilience and not chasing higher returns the closer you get to retirement. You still want to aim for growth on the investments that will not be utilized in that 7-year period, because we also have another dynamic at play, which I referred to in my last video, which is own assets or get left behind, because we have a lot of money being printed that is diluting our currency, where we want to make sure that our purchasing power is protected. So this is kind of a balance between reacting to risk, but also understanding that there's also risk in being too safe. So it's a very delicate balance that we must juggle, which is why looking at that cash flow and doing a deep dive into your retirement strategy is usually the right bet. And if that's something of interest to you, we have a QR code here on the right side where you can sign up for a free session. What that ultimate leads to is leads to a package of meetings on a flat fee basis that starts at 750 bucks and goes up to 1200 bucks for a series of meetings to dissect where you're at. So lastly, I'll just leave you with some key reminders. Recognize your risks without assuming a collapse. Rebalance. Make sure you understand that those safe assets are your insurance, but don't be over allocated to the G fund because it will not keep up with inflation over time. Position your account in terms of how you're going to be approaching your retirement and revisit that model. Work with a professional if you feel like this is something that may be a little bit over your head. You've never done a deep dive in that budget, how much money you'll be spending in retirement, but recommend that you do it with a CFP. CFPs are really are really our designations that we hold here at Capital Financial Planners. In fact, all 4 of our advisors hold the CFP. So it's really someone that has taken that next step to their financial planning career. It's not an easy designation to get, and it ensures that fiduciary conduct with that advisor, as well as higher ethical guidelines. So again, if you're wanting to sign up for a consultation, we have a QR code. We also have a QR code to follow our YouTube channel. If you're not ready to meet with us yet, totally understood. Just like our video and subscribe to our channel so you get further updates in the future. Thank you so much for watching this video, and we look forward to seeing you in some of our other videos or live sessions coming up here soon.